Company analysis, the third and final step of top-down approach has arrived. In this step, in this video onwards, we'll talk more about company-specific data, like how to read company's income statement, balance sheet, income statement, cash flow statement, calculating ratio, how to connect dots. So from this point onward, the investing mastery series is gonna get bit technical, bit more advanced. So if you've not gone through earlier videos, my dear friend, we have covered 11 days, 11 different videos. We started from why investing. We talked about asset allocation, what is the ideal way. We talked a lot. And now, in the top-down approach, first we talked about understanding the macro factors like where companies, country is getting into, which phase the economy is into, and whole of your investment decided depends upon where exactly country stands. As I told in that particular video, just to reiterate that fact, if country is going through the recession, then capital goods companies cannot perform well. Like luxury car segment, they are definitely going to see some downturn. First thing, macro. Okay, I want you guys to tell me what was the second step in top-down approach. What was the second thing that we analyzed in the last video? Tell me in the comment box. Yes, awesome. Thank you. I hope you would have written the comment. It is sector and subsector analysis. Like a company can do good only if that particular sector is doing good. If a sector is not doing good, company, however strong management, however strong fundamentals it might have, it will not be able to perform good, right? So I talked in the last video that if you can identify the sector which is going to perform or outperform the next 10-15 years, probably you can compound your wealth, and you can just compound your wealth many fold if you can identify those particular sectors. Having identified those sectors, in this particular video, from this particular video onwards, we will try to find out which company is best position for me to invest into. Now when I say best position, what typically I'm trying to do is, first thing I look at is company, country should be, country data, macro data should be supporting my investment decision. Sector growth or the mega trend should be supporting me. And the third, when I talk about a company specific thing, that company has to be having a potential of growing fast. And at the same point of time, I look at those companies which are undervalued. Now, these two factors must get combined for you to manifold your wealth. Number one, company should have good growth potential, and number two, it should be undervalued. Like, I'll talk about this for a minute and then we'll jump onto the topic. If a company has got a good, great potential, but it is not undervalued, it is already fairly priced, or even I will say it is overvalued. Already lot many people have invested into this. The prices have gone skyrocketed. So now if you enter into that company, of course, company may grow, incomes will grow, everything will happen. But your share price will not grow manifold. Your wealth will not grow manifold because the growth was already discounted when you entered, because you entered at a really high price. If you agree with me, you can just type in agree in the chat box, right? You must find an undervalued company, then and then only you can, compound the growth. And in the upcoming video, through analyzing income statement, balance sheet, and through calculating various ratios and connecting dots, and of course using some tools which also we're going to discuss in the videos to come. Of course, it will take some time, but yeah, using those tools, using those screeners, you can easily find out a company which has the growth potential, and at the same point of time which can which is undervalued, where your growth potential is also superb. So with that said, let's jump into the topic. And today we're going to do the company analysis. So this is the last step in the top-down approach. Analyzing company's individual position, like by analyzing its income statement, balance sheet, and cash flow statement. We can also use the ratios to understand the company's positions better. And it is not like we can use, I would rather say we have to use. Right? If you agree with me, just you can type in agree in the chat box. See, one request I'm time and again making to you guys is, like, keep liking our channel, keep subscribing it, keep hitting the like button, and keep do commenting. when you keep commenting on the videos, I look at it, I get the energy like, okay, whatever hard work I'm doing, whatever content I'm creating, people are actually consuming it for their betterment, for their benefit. And that is something that will motivate me to do better and better. So if you don't comment, at some point of time, I feel like, oh my God, I'm doing this much hard work. See, for the YouTube videos, I'm preparing special PPTs, special presentation. Few videos back, I told you that to give you better experience, we purchase this mic. Everything we are doing, but if you don't comment, we sometimes feel down like, okay, we are doing this much hard work, but nobody's seeing that. So please do the commenting, right? So we have to use the ratios. In this particular video, we're going to talk about income statement. In the next video, we'll talk about balance sheet. In the next to next video, we'll talk about cash flow statement. And then we will start with the ratio analysis series that is very, very vital for this. So as far as income statement is concerned, income statement or a profit and loss statement reflects the profit earned or losses incurred during an accounting period. So income statement always shows the income or profit or loss for the period, whereas balance sheet shows the position as on a particular date. We'll talk about that in more detail when we come to the video of balance sheet. But income statement reflects what has happened during the period, during the year, during the quarter, depending upon for which period we are reading the income statement. Whereas balance sheet, it talks about as on date. So how does an income statement look like? We will have a bird eye view over here, right? So those of my friends who are coming from a non-commerce background, who might feel like, Ahmed, this is going above the head, don't worry. Don't at all worry. We're going to have a in-depth session about how to form income statement and all that. But this is a bird eye view. Just have a look at this. Try to understand this. If you don't understand anything, do let me know in the comment box and I'll be elaborating that. I'll be answering to your comment. That is something I can do for you guys. So the first top thing that comes in the income statement is sales. Like for example, I'm explaining you that my company did a sales of 10 lakhs during the last year or last quarter. Let's say last quarter. Okay. So sales, and when we say sales, it includes both the sales done on cash basis as well as sales done on credit basis. There are two, bases of accounting. One is a cash base and one is an accrual base. We'll talk about that later, but I'm telling you right now. Right now, I'm preparing this income statement as per accrual basis. Accrual basis means what? To give you an example, like I'm, dealing in this mic. I'm selling this mic. So I sold mic of 4,000 rupees. This one set cost around 4,000 rupees to, for example, Raju. I sold one mic costing 4,000 to Raju, but Raju did not pay me money. He said, Amit, I'll pay you after 1 month. Right now, I don't have money, but I want to create content that will help the people. I said, okay, dear, I trust you. Keep this mic, take this mic, here is your sales invoice, and give me money after 1 month. So, this is typically a credit sales. But this is included in this amount of 10 lakh rupees because I'm doing my accounting on an accrual basis. I hope that makes sense. So from sales, I need to subtract cost of goods sold. Now, what is cost of goods sold? My dear, cost of goods sold is basically the cost incurred to procure or to produce the goods that you sold. Like if you're a trading entity, you will be procuring finished goods and selling it. So cost of goods sold typically means the cost that you incur to procure, or if you are a manufacturer, the cost you incur to manufacture the goods that you have sold. Okay, and cost of goods sold automatically adjusts inventories. Like if there are opening stock, if there is closing stock, it is adjusted because we say cost of goods sold. So for example, that is 6 lakh rupees. So if I do the sales minus cost of goods sold, that gives me gross profit. In my example, I can say that gross profit is 4 lakh. Okay, I have not subtracted any expense of my business. Like if I'm running a shop, I must be paying electricity bill. If the shop is rented, I must be paying rent. I must be paying salaries to my employees. So all these things I have not subtracted. It is just gross profit. Like okay, 10 lakh rupees of worth goods I sold, and to sell that good, to procure that goods, I had to spend 6 lakh rupees. So 4 lakh is my cost of goods sold. From that, we subtract operating expenses. Like operating expense means the cost of running or operating the business. It can include salaries, right? It can include salaries. It can include electricity. It can include your shop rent. It can include your office boys. It can include your cleaning expenses. Any damn expense that you incur to run to operate your business is something that we call as operating expenses. Yeah, it can be your salesman commission, it can be your advertisement cost, it can be your marketing cost, everything. Every cost that you incur to run the business is something called as operating expense. If I subtract this, I get earnings before interest and tax, EBIT. Some people also call it operating profit because this is the profit that I generate by doing the trading activity or doing the manufacturing activity. This is actually the core profit of my business activities. From that, if I've taken the money on loan, we're going to talk about balance sheet and how this money comes. I got to subtract interest expense, I got to pay interest. Let's say 50,000 interest I pay. So earnings before interest and tax. From that I've paid interest. So that gives me earning before tax. Let's say that is 1.5 lakhs. Continuing further, so EBT is 1.5 lakh. Then I have to pay tax. Modi ji, Nirmala Sitharaman ji will come and they'll say, Amit, you're doing good business, you're earning good, give us our tax, right? So Modi ji will come, Mitro, tax de do. So we got to pay the tax. We got to be, law-abiding citizens. Rate I'm not getting into. I'm just giving you a round figure of 50,000 rupees. So the calculations remain easy. That gives me profit after tax. That is 1 lakh. Now profit after tax in a company form is available for shareholders. And in case of a proprietary or partnership business, it is available for partners or proprietors, right? But if we talk about a company perspective, because we're going to analyze the financial statement of companies only because we're going to invest into listed companies. So I'll say from profit after tax, the first priority if anybody gets is the preference shareholder. First, we got to pay preference dividend before we pay anything to the equity. So let's say I paid equity dividend, preference dividend of 20,000 rupees. Then I'll be left with 80,000 rupees, which is called equity earnings. This earnings is available for equity shareholders. Equity shareholders can decide in the annual general meeting what they want to do with this equity earning. If they want, they can take the whole money to home in the form of dividend. If they want, they can reinvest some part of money in the company. They think that okay, company is growing, company is generating good profit, we don't need money, let us reinvest. So this amount can be transferred to reserve surplus. There can be mix of both. Like 20,000 has been taken in the form of dividend, 60,000 has been retained, anything. So this is totally equity shareholders earning available at their disposals, and equity shareholders can decide what they want to do with that. And if I divide it with the number of shares, that is, number of equity shares outstanding, it gives me earnings per share. Now, my dear, EPS is a very, very, very important parameter while taking the investing decision when we talk about ratios. By the way, this itself is a ratio. Equity earning divided by number of shares, EPS itself is a ratio. So we're going to talk about more in the ratio analysis modules, ratio analysis videos. But I hope you got a bird eye clarity about what the income statement is and all about. So if you got a bird eye clarity about how income statement looks like, how do I look at it, just type clear in the chat box. And also at the same point of time, I would request you guys, if you watch this video for last 14 minutes, it shows you are serious, you are committed, you're going to compound wealth in the time to come. So for your betterment, I would like to request you to tell me your 3 biggest learning from this particular video. I'm looking forward to your learnings. I'm looking forward to your comments. As I said, it motivates me, it inspires me to do more work. Looking forward to your comments. Looking forward to see you in the next video where we're going to talk about balance sheet. Thank you for watching this one. Bye-bye.